Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have Chris Engelbert. He's Managing Director over at Byrne Wealth Consulting. And we're here for the monthly Registered Investment Advisor Update. And we're going to take a look at alternative investments and managers. Real hot topic in the advisory space right now. Chris, as always, it's great to have you here with us. Now, using alternative investments in your portfolio, we're starting to see more advisors and institutions adopt this.
Yeah, it's an asset class that everybody wants to get involved in, but they don't really know how to. And so we suggest to retail clients that they really ask themselves a question when somebody tells them, hey, alternatives. They've got to discover where they want to put it in their portfolio and how much they want to do it. Over the last couple of years, there's been different ways to access alternative investments. There's more Act 40 funds. There's more ETFs out there. And what we're really excited about is that many of the platform providers are really opening up with lower minimums in order to get into alternatives.
Yeah, because it used to be you have to have like a $250,000 threshold to be a qualified investor, and everyone's looking for that alpha outside of stocks and bonds. Alternative investments, though, I think it's a good thing with new products coming out because they can be illiquid and hard to move in and out of your portfolio.
Yeah, that's one of the things that happened, and people discovered in 2008 that when we had the global financial crisis that many alternatives, they all correlated the same way, and liquidity was a big problem. So I really stress to people when they decide to start looking at alternatives, there are many, many different strategies. We'll go into a minute one of my favorites that we're looking at right now. But I always tell people you can't just do one alternative strategy. You've got to have a game plan that maybe you do a long short, maybe you do a structured credit, maybe you do a distressed debt strategy. So you have a game plan where you're saying, okay, so much of my portfolio I want to look at doing this, but what of the strategies do I want to do in that segment?
Now, how do RAs work with alternative investment managers? It's not as simple as picking an ETF or a mutual fund and you kind of forget it, set it and forget it. You're constantly doing your due diligence on a more regular basis, right?
Yeah, correct. I mean, this is where we really earn our keep. One of the things I try to tell people is like real estate, location, location, location. Alternative managers is due diligence, due diligence, due diligence. So I probably get across my desk in a year 150 to 200 different managers with different strategies. Obviously, the last couple of years, a lot of the big plans or big alternative managers, I shouldn't say have blown up, but they've given money back. And so now we see a very exciting trend. I call it Alternatives 2.0, where some of these guys that worked for the big boys are now out there raising money and raising capital themselves, and they've got a good slide deck, they've got some assets, but at some point the due diligence really comes to play as far as how much of a minimum do they have. We usually say you got to at least have $100 million under management and some kind of track record that's longer than 2 years.
Right. Well, let's take a look at a couple of the charts because, you know what, the narrative really hasn't changed much since January. Let's pull up the S&P 500 first. That big 20% rally off the bottom in December. Is this a rally within a bear market, or does this bull market still have legs?
Yeah, we actually believe that this could be the start of something new. I mean, our risk indicators got so compressed at the end of December. We are looking much more favorably on the equity markets this year. We think a lot of people got locked out. They got spooked out in the fourth quarter of 2018. They still don't believe that this rally's for real. And if you look at some of the other charts that we're going to go through in a minute, there's been a lot of money that's come pouring in, but there's still a lot of money on the sideline.
Yeah, well, you know what? That's why your job as an RA, stay invested,
correct,
stay diversified. Let's look at the Nasdaq comp next. That's actually outperforming the S&P 500.
Yeah, I mean, what worked the last couple of years is working again this year. Large cap growth. There was a real vicious rotation last year amongst the FANG stocks. Just when you think they're down and out, they get legs and they start to come back again. We have a lot of discussions in our shop, and I talk to a lot of money managers about when is large cap growth going to go away and large cap value is going to come back. There's been such an outperformance issue by large cap growth over the last couple of years. I feel a little sorry for large cap value guys, but they're still making money for clients.
All right, and let's move along to the Russell 2000. On a relative basis, it's still lagging. Does that mean anything? Because I know you look at that as an indicator overall.
Yeah, we do, and there's been some discussion about how the fact that with supposedly easy money, many of the Russell 2000 stocks really aren't, their debt needs to be restructured, but they also offer a good place as far as growth goes too. Again, it does concern us the fact that we're not seeing all the horses pulling, the wagon along. That you've got the small mid-cap stocks really kind of lagging versus the large cap. It's been a large cap rally again.
It's not like 2017 when everything was up, up, up. All right, let's move along to the 10-year Treasury note. This has been the topic of conversation and the whole yield curve.
Yeah, I mean, really what was freaking people out in the fourth quarter is the words, hey, we're going to have a recession, and the Fed's raising, they got things wrong. I think the big surprise has been the fact that after the risk trade that happened in the fourth quarter where people were selling stocks and buying bonds, we've then seen yields stay low relatively compared to where everybody thinks that they should be. We think the Fed is focused like a hawk on where the 10-year Treasury is along with short-term rates because they don't want to see an inverted yield curve. But we also think that there's some technical things going on with European bonds and negative interest rates. There's a lot of global investors that are looking at the 10-year Treasury and going, hey, it's a great place to be.
Yep. All right, let's wrap it up with crude oil. This has been interesting. I don't think anyone expected it to ramp up to the levels where they are now.
Yeah, I don't think anybody did. I mean, if you look at a lot of the asset classes so far for 2019, a lot of stuff didn't work last year. Everything's working this year, and I think a lot of people are very surprised by the viciousness of the rally in crude oil. We still think there's more to go. Crude oil was trading in the 70s last year. We still think that that's the target for 2019. Unfortunately, it may mean higher prices for the consumer at the gas pump, but it looks like crude wants to go higher.
Well, the administration is going to be watching that number like a hawk. That's going to be key there. All right, let's wrap it up. Going into earnings seasons, expectations are pretty low.
Yeah, they are. If you look at some of the different sectors, some are doing a little bit better than others. I mean, so far, a lot of people are keying off the financial stocks to see if this rally can continue to go. We kind of think they're missing the boat a little bit, that they really got to be looking at the energy area. There's been a big improvement the last couple of years in a lot of the energy companies with their earnings. A couple of the companies in the fourth quarter had blowout earnings on the energy side, and nobody paid attention to the stocks, and they've been quietly rallying. So, expectations are very low for earnings, but we think also what's going to happen is that there's going to be a situation where a company knocks it out of the ballpark, stock does great, company misses by a little bit. You've seen that they've been, taken out to the woodshed. So
I mean, comps are pretty tough from 2018. It was a pretty good year. All right, Chris. Well, next time we see you in May, we should be closer to the tail end of earnings season. We'll see where the story takes us there.
Yes, thank you very much.
Thank you so much, as always, for joining me, and thank you for joining me for Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.